You sit there staring at the glowing screen of your device, eyes glazing over as you hunt for the magic pill, the secret formula, the financial elixir that will undo 40 years of mediocrity and poor judgment. You are looking for safe investments because your knees are starting to creak and your hairline is retreating. And suddenly the reality of your own mortality has made the prospect of losing money terrifying. But here is the brutal truth that your delicate ego refuses to accept you are asking the wrong question. You are obsessed with winning, with finding the next Amazon in its infancy, with hitting a home run that will let you retire to a villa in Tuscany. It is absolute asinine folly. If you are over 40, you do not need to be smart. You simply need to not be an idiot. The investment world is a landscape of sewage filled with promoters and charlatans selling you rat poison coated in sugar. You think you can wade into this cesspool and pick out the gold nuggets because you read a blog post or watched a 10-minute video. It is delusional. You are not Warren Buffett. You are not a genius. You are a middle-aged individual running out of time, and the market does not care about your retirement dreams. The great German mathematician Carl Jacobi had a simple method for solving difficult problems. Invert, always invert. He knew that many hard problems are best solved when they are addressed backward. You are asking, how can I make a lot of money safely? That is the forward question, and it leads to speculation, leverage, and ruin. The inverse question, the one you should be asking, is what will kill me financially? If you avoid the things that kill you, you survive. And if you survive long enough, the miracle of compounding does the heavy lifting for you. It is standard doctrine, something we have preached at Berkshire since the beginning, yet nobody listens because it isn't sexy. It doesn't get the dopamine flowing like a crypto trade or a leveraged option bet. I am not your advisor. But if I were, I would tell you to consider avoiding the stupidity that wipes out the capital you have spent 4 decades accumulating. You must understand that the game of investing is not about jumping over 7-foot bars. It is about finding 1-foot bars that you can step over. But you, with your ego and your envy, you insist on trying to do backflips over the high bars because you see your neighbor driving a Tesla and you think you're falling behind. That envy is the silliest of the 7 deadly sins because it's the only one where you don't even have any fun. Let us look at the history of the truly wealthy, the titans of the old world, compared to the frantic, caffeinated squirrels of the modern market. Look at John D. Rockefeller or Andrew Carnegie. Look at the early days of Berkshire Hathaway. We did not run around like decapitated chickens trying to day trade our way to prosperity. We bought cash flows. We bought businesses that were so simple a ham sandwich could run them. We sat on our asses. That is the key, sitting on your ass. You think activity equals productivity. You think that by constantly moving your money, rebalancing, and chasing the latest hot sector, you are managing your wealth. You are not managing wealth. You are generating fees for Wall Street and taxes for the government. You are feeding the croupier. In the 2000 Berkshire annual meeting, I said that if you buy a business just because it's a good idea or it's changing the world, you are going to get slaughtered. The internet changed the world, but it also destroyed billions of dollars of capital for idiots who bought the narrative without checking the price. The modern fool buys a story. The wise man buys a reality. You are buying innovation at 100 times earnings because you are terrified of missing out. That is not investing. That is gambling with the rent money. I have seen more people fail because of liquor and leverage being borrowed money than almost anything else. You are over 40. You have a mortgage, perhaps tuition to pay, perhaps aging parents. You cannot afford to go back to zero. When you use leverage, you are putting a gun to your head and hoping the chamber is empty. It is madness. At the 2002 Wesco annual meeting, I told the crowd that if you are smart, you don't need leverage, and if you are dumb, you have no business using it. It is that simple. Yet I see men of your age taking out home equity loans to buy stocks or trading on margin because they want to accelerate their returns. You are not accelerating returns. You are accelerating your demise. You are driving a car with a spike coming out of the steering wheel, aiming at your chest. Every bump in the road becomes a fatality. The market will drop 50%. It happens. It happened in 1973. It happened in 2000. It happened in 2008. If you are leveraged when that happens, you are wiped out. You don't get to wait for the recovery. You are carried out on a stretcher. You must apply the mental model of inversion to your own temperament. What causes bad decisions? It is usually a Lollapalooza effect, a confluence of psychological biases acting together. You have the social proof bias, where you buy because everyone else is buying. You have the commitment and consistency bias, where you refuse to sell a loser because you don't want to admit you were wrong. And above all, you have the deprival super reaction syndrome, where you act irrationally because you feel something is being taken away from you, usually an opportunity. I made a colossal mistake myself by ignoring this. In 1979, we sold our position in Belridge Oil. It was a company sitting on a massive amount of oil in Bakersfield. We bought it cheap, and the price went up. I looked at the valuation, and my rigid, distinctive adherence to value made me think it was getting too expensive. I sold. I pocketed a profit. I felt smart. Shortly after, Shell Oil bought the company for a price that was roughly 30 times what we had paid. I left hundreds of millions of dollars on the table, billions in today's money. Why? Because I was trying to be too clever. I was trying to time the exit perfectly. I didn't sit on my ass. I let a rigid adherence to a specific valuation metric blind me to the massive, inevitable bonanza of the underlying asset. I was a damn fool. If I can make a mistake of that magnitude after decades of experience, what chance do you have? You, who gets your financial news from a 20-year-old on TikTok. The arrogance is breathtaking. To survive the next 20 or 30 years, you must make the 3 decisions that define a defensive, inverted life. 1, you must decide to never, under any circumstances, borrow money to buy stocks. 2, you must decide to ignore the market fluctuations completely, treating the stock exchange as a manic depressive partner who is sometimes generous and sometimes suicidal. 3, you must decide that you do not need to be rich quickly. You only need to be rich eventually. If you cannot make these 3 decisions, you should take your money, put it in a mattress, and accept that inflation will eat it, because that is a better fate than losing it all to your own stupidity. The financial industry is designed to make you feel inadequate. They invent complex instruments, derivatives, structured notes, inverse ETFs to make you feel like you need a PhD to invest. It is all twaddle. They do this to justify their fees. They want you to think that safe means hedged. It does not. Safe means understanding what you own. Safe means owning something that generates cash. Safe means having a margin of safety so large that you can be wrong and still not lose money. This is the concept of the margin of safety that Ben Graham taught, and it is the holy scripture of survival. If you are building a bridge and you think a 10,000-pound truck will drive over it, you build it to hold 30,000 pounds. You don't build it to hold 10 0.01 pounds. But in the markets, people buy stocks priced for perfection. They buy Tesla or Nvidia assuming that growth will continue to the moon forever. They are driving a 10,000-pound truck over a bridge built for a bicycle. It is a disaster waiting to happen. You have to learn how to handle the misery of watching other people get rich faster than you. This is the hardest part of the inversion process. To ensure safety, you must be willing to look like a fool while the crowd celebrates. In the late 1990s, during the dot-com bubble, people said Warren and I were senile. They said we had lost our touch because we wouldn't buy tech stocks that had no earnings. We sat there bored while our neighbors got rich on paper. It was irritating. It takes a certain temperament to watch a guy with an IQ of 80 make $1 million while you make nothing. But then the clock struck midnight. The carriage turned back into a pumpkin. The mice ran away. The liquidity dried up, and those paper millionaires were looking for jobs while we were sitting on a mountain of cash ready to buy the wreckage. That is the essence of safety. It is not about avoiding volatility. It is about avoiding the permanent loss of capital that comes from chasing the herd over the cliff. If you are over 40, you must realize that your circle of competence is likely very small. You know your job. You know your local neighborhood. You do not know the intricacies of global semiconductor supply chains or the future of decentralized finance. Stop pretending you do. Stay within your circle. If you step outside of it, you are not investing, you are donating. The truly safe investments are boring. They are painfully, excruciatingly dull. They do not make for good cocktail party conversation. While your friends are talking about their 10x returns on some obscure altcoin, You will be talking about a railroad or a utility company or a diversified index. You will sound like a dinosaur. Good. Be a dinosaur. The dinosaurs ruled the earth for millions of years. The frantic mammals get eaten. You must also invert your understanding of risk. The academic definition of risk is volatility. How much the price bounces up and down. This is total nonsense. As I said at the 2007 WESCO annual meeting, volatility is not risk. Risk is the probability of permanent loss. If a stock drops 50%, but the business is sound, that is not risk, that is an opportunity. But to you, with your weak stomach and your obsession with daily account balances, that drop feels like death. You panic, you sell at the bottom, you turn a temporary fluctuation into a permanent loss. That is the ultimate stupidity. You are the risk. The asset is not the risk, you are. Your inability to control your emotions is the single greatest threat to your financial survival. You must construct a portfolio that protects you from yourself. So before we even talk about what to buy, you must purge your mind of the garbage. You must vomit out the get-rich-quick fantasies. You must accept that you are late to the game, and the only way to win now is to play defense. You must look at the financial world and say, I will not participate in the madness. You must be willing to be lonely. You must be willing to be bored. You must be willing to sit on your hands for years at a time doing absolutely nothing while the world around you screams for action. If you cannot do that, if you cannot conquer your own psychology, then no list of safe investments will save you. You will find a way to ruin even the safest asset. You will buy high and sell low. You will leverage a treasury bond if given the chance. Fix your head first, invert the problem. Stop trying to be brilliant and start trying to be rational. Rationality is a moral duty, and in a world of madness, it is the only safety you will ever find. Let us discuss the most ruthless creditor you will ever encounter, one that does not negotiate, does not offer extensions, and does not care about your excuses' time. If you are over 40, you are mathematically dying. That is not a morbid sentiment, it is an actuarial fact. When you were 20, you had a 50-year runway to let the magic of compounding interest turn a pittance into a fortune. You could afford to be stupid. You could afford to buy a speculative tech stock, watch it go to zero, laugh it off, and start over. You had the luxury of recovery. Now, you do not. The sand in the hourglass is not just falling, it is accelerating. The mathematics of compounding are heavily backloaded. The massive explosions of wealth happen in the final years of the process. Warren and I are rich not because we are brilliant stock pickers, though we are certainly not idiots, but because we have been doing this since the days when a hamburger cost a nickel. We have had 70, 80 years of a runway. You have perhaps 20 good years left before the cognitive decline sets in or the energy fades. You are trying to compress a lifetime of compounding into a 2-decade window. This creates a dangerous psychological pressure that usually leads to disaster. Because you feel the pressure of time, you feel the urge to hurry. And in the financial markets, hurry is the cousin of death. You look at the calendar, you look at your bank account, you calculate that to hit your number. You need a 20% annual return. So you reach for yield, you reach for growth. You start swinging at pitches that are way outside the strike zone because you feel you must hit a home run to catch up. This is the algebra of a fool. The market does not care what return you need. It only offers what it offers. If the market is offering 5% and you need 20, and you try to bridge that gap with leverage or speculation, you will not get 20, you will get negative 50. I am not your advisor, but if I were, I would tell you to consider that the first rule of compounding is to never interrupt it unnecessarily. If you lose 50% of your capital at age 45, you require a 100% gain just to get back to where you started. Do you know how hard it is to get a 100% gain without taking risks that could wipe you out again? It is nearly impossible. You have dug a hole so deep that you will spend the rest of your productive life trying to crawl out of it, only to die at the rim. This brings us to the concept of the fat pitch. I have always loved the book, The Science of Hitting by Ted Williams. Ted was one of the greatest baseball hitters of all time, and he had a chart of the strike zone broken down into 77 individual baseball-sized cells. He knew that if he swung at a ball in his sweet spot, the fat pitch, he would bat 400. If he swung at a ball on the lower outside corner, Even if it was technically a strike, his average would drop to 230. In baseball, if you don't swing at 3 strikes, you are out. You have to swing. But in investing, there are no called strikes. You can stand at the plate, bat on your shoulder for 6 months, 2 years, 5 years. The pitcher, the market, can throw General Motors at 40E, and you can do nothing. They can throw Microsoft at 300, and you can do nothing. You can stand there and wait until the market panics, until there is blood in the streets, and it throws you a fat pitch right down the middle, a wonderful business at a distressed price. Only then do you swing. And when you swing with all your might. But you, the modern investor, you cannot stand still. You have action bias. You feel that if you are not buying and selling, you are not working. You are addicted to the noise. You are like a man in a room full of ticking clocks, running from one to the other, trying to synchronize them, achieving nothing but exhaustion. You must understand the algebra of opportunity. Every time you buy a stock, you are making a statement. You are saying this asset is better than cash, and it is better than every other opportunity available to me in the entire world. That is a very high bar. Most things do not clear that bar. The vast majority of stocks are mediocre. They are run by mediocre management in mediocre industries. Why would you put your precious decaying time into mediocrity? You should be ruthlessly rejecting 99% of everything you see. You're too hard. Pile should be overflowing. Your yes pile should be nearly empty. This requires a temperament that most people simply do not possess. It requires the arrogance to say no to Wall Street's endless menu of garbage, and the humility to admit that you only understand a tiny fraction of the world. Let me tell you about a mistake that haunts me, a mistake of omission that cost Berkshire Hathaway billions of dollars. I mentioned Belridge Oil before, which was a mistake of selling too early. But there is a worse kind of mistake, the mistake of seeing the fat pitch, recognizing it, having the money, and simply sucking your thumb. I am talking about Walmart. In the late 1990s and early 2000s, it was painfully obvious that Walmart was a juggernaut. It was a machine. It was destroying competitors. It had immense pricing power, and it was run by fanatics. I knew it. Warren knew it. We admired the hell out of it. The stock was trading at a price that was fair, not a steal, but fair. But I was too clever for my own good. I wanted a bargain. I wanted to buy it for a few pennies less. I watched it. I waited. And while I waited, the stock marched upward. It compounded. It split. It paid dividends. It became one of the greatest compounding machines in history. I cost our shareholders billions of dollars because I wouldn't pay a slightly higher price for a truly great business. I was penny wise and pound foolish. I was looking for a cigar butt with one puff left in it when a gold mine was sitting right in front of me. This is the danger of a rigid mind. As you get older, you must learn to distinguish between cheap and value. A great business at a fair price is the holy grail. If you find one, a company with a durable competitive advantage, a moat, as Warren calls it, an honest management, you buy it. You don't try to time the bottom to the exact cent. You get on the train, because if you miss the train, you are left standing on the platform clutching your cash while the wealth of a generation pulls away from the station. That is opportunity cost in its most brutal form. It is the ghost of the wealth you could have had mocking you for your indecision. The concept of opportunity cost is the only intelligent filter for your life. In economics, everything is a trade-off. If you marry the wrong person, the opportunity cost is the happy life you could have had with the right person. If you take the wrong job, the opportunity cost is the career you missed. In investing, cash is your option on the future. When you hold cash, you are paying a price. Inflation erodes it. But you are buying an option, the ability to strike when the world goes to hell. The modern fool hates cash, he says. Cash is trash. He puts every cent into the market because he fears inflation. But when the crash comes, and it always comes, he has no ammunition. He is fully invested in declining assets. He cannot buy the fat pitch because his money is trapped in the lean pitch he swung at 2 years ago. You must view your liquidity not as a wasting asset, but as a loaded gun waiting for a target. This brings us to the parimutuel system of betting. I have always been fascinated by horse racing. In a parimutuel system, the odds change based on how everyone else bets. If everyone bets on the favorite horse, the payout becomes tiny. Even if the horse wins, you make no money. To win big, you have to find a mispriced gamble. A horse that has a 50% chance of winning but is paying out 10 to 1 odds. The stock market is a parimutuel system. The safest stocks that everyone loves, the popular tech giants, the darlings of the media, are often the favorites with the worst odds. The price is bid up so high that future returns are mathematically impossible to achieve. You are buying a great horse at a terrible price. Safety, true safety, comes from finding the discrepancy between price and value. But you cannot find that if you are swinging at every pitch. You have to wait for the crowd to be wrong. You have to wait for the favorite to stumble or for the dark horse to be ignored. And waiting is suffering. Do not underestimate the pain of it. It is physical. You will see your brother-in-law making money on some electric vehicle startup that has never sold a car. You will see your coworkers retiring early on crypto profits. You will feel like a fool. You will feel old. You will feel that the world has passed you by. This is the test. The market is designed to transfer money from the impatient to the patient. If you cannot handle the suffering of an action, you will be the source of someone else's profit. You must cultivate a seamless web of deserved trust with yourself. You must trust your analysis enough to sit still. Blaise Pascal said, all of humanity's problems stem from man's inability to sit quietly in a room alone. In investing, this is literally true. Your inability to sit on your hands is why you are not rich. So here is the synthesis for the man over 40. You have less time, which means you have less capacity for error. You cannot afford the zeros. Because you cannot afford the zeros, you must restrict your activity to only the highest probability bets, the fat pitches. But because fat pitches are rare, you must spend most of your time doing nothing. This creates a paradox. To hurry up your wealth accumulation, you must slow down your activity. You must become a monk of the market. You must look at the daily ticker tape and treat it with the contempt it deserves. You are looking for the Lollapalooza, the moment when multiple factors converge to create a situation of low risk and high return. They happened. They happened in 1974. They happened in 1987. They happened in 2009. They will happen again. But if you are fully invested in mediocrity when the Lollapalooza arrives, you will miss it. And missing it is a sin for which the market offers no absolution. You must also understand that safe does not mean risk-free. There is no such thing as a risk-free asset. Even government bonds carry inflation risk and currency risk. Safe means that the odds are overwhelmingly in your favor. It means you are the house, not the gambler. The casino does not worry about the outcome of a single spin of the roulette wheel. They know the math. They know that over 1 million spins, they will win. You must become the casino. You must stop betting on the spins and start owning the wheel. This means owning businesses that generate cash regardless of what the Fed does, regardless of who is president, regardless of what the latest geopolitical crisis is. We will discuss exactly what those businesses are, but first, you must accept the discipline. Without the discipline, the list of investments I am about to give you is useless. You will buy them at the wrong time, sell them at the wrong time, and blame me for your incompetence. Do not be the man who wakes up at 65 broke and bitter, telling stories about the stocks he almost bought. Be the man who bought the right thing, sat on his ass for 20 years, and let the world do the work for him. It is not exciting. It is not glamorous. It is simply the only rational way to behave. Now, if you have purged the gambling demon from your soul and accepted the weight of your own mortality, we can finally talk about the specific assets that might actually survive the coming storm. But be warned, they are not what you think, and they are certainly not what the shills on television are selling you. There is a story I love to tell about Max Planck, the Nobel Prize-winning physicist. After he won the prize, he went around Germany giving the same lecture on quantum mechanics. Over time, his chauffeur memorized the lecture. One day, the chauffeur said, "Professor Planck, it must be boring giving the same speech every time. I can give it for you in Munich, and you can sit in the audience wearing my chauffeur's cap." Planck agreed. The chauffeur went on stage and gave the lecture flawlessly. Then a physicist in the back raised his hand and asked a very difficult question. The chauffeur replied, "I am surprised to hear such an elementary question in an advanced city like Munich. I will let my chauffeur answer it." This is the problem with the modern financial world. It is overrun with chauffeurs. They have the vocabulary, they have the suits, they have the hairspray. They can say EBITDA and quantitative easing support levels with perfect diction, but they do not know anything. They have chaffer knowledge. They are mimics. They are actors playing the role of experts. And if you listen to them, you will lose your money. You turn on the television and see these talking heads screaming about the stock of the day. They are not investors, they are entertainers. They are paid to keep your eyes glued to the screen so they can sell you pharmaceutical ads. Do you really think a man who is on TV at 6 in the morning every single day has any idea what the market will do next? If he knew, he wouldn't be on TV. He would be on a yacht in the Mediterranean, or more likely, sitting in a quiet room compounding his capital like Warren. These people have no skin in the game. If you follow their advice and lose your retirement, they do not lose a dime. In fact, they get a bonus for high ratings. It is a moral cesspool. I have said before that I would rather make money selling piano wire to the mafia than by listening to these charlatans. You must ruthlessly excise these voices from your life. If you are over 40, you do not have time for noise. You need signal. And the signal does not come from a man who is paid to shout. This brings us to the concept of the circle of competence. This is the most important concept in the history of investing, and it is the one you are most likely to ignore because of your ego. You have to know what you know, and more importantly, what you do not know. The perimeter of your circle must be defined with steel walls. Inside that circle, you are the master. Outside that circle, you are the prey. I know a lot about banks. I know a lot about insurance. I know a fair amount about consumer goods. I do not know anything about biotechnology. I do not know anything about cryptocurrency. So I do not touch them. I do not care if they go up 1,000%. I do not care if my neighbor makes a fortune in them. To me, they do not exist. You must have the discipline to say, I don't know. It is a powerful sentence. It is a liberating sentence. But you are afraid to say it because you think it makes you look stupid. On the contrary, admitting ignorance is the highest form of intelligence. The stupid man thinks he knows everything. The wise man knows his circle is small.